Hi everyone, this is Alan Rosenfield, Managing Director of Harmony Asset Management, with our latest edition of Thoughts and Comments. We're going to do something a little different for the next few weeks. We're going to do some shorter videos that are in and of themselves educational, focusing on one or two specific spots. But at the end of all of that, we'll tie it all back in together with how we've been positioning portfolios. So it'll be educational at a very high level, but then in the end you can see how we take all these pieces and tie them together. So today we're actually going to explore the S&P 500 index. And what brought this about was I was reviewing portfolios and reviewing results of the markets over the last couple of years since the COVID pandemic. So from 2022 going forward, so basically a little over 2.5 years. And what I found was rather interesting. While the S&P was up 16.9% in that 2.5 year period, which is okay, not phenomenal, but not bad. If you looked at other broad market indexes, none of them had performed as well. Example, the equal weighted S&P index is up only 7.1% during that same time frame, so just a little over 2% a year. The New York Stock Exchange Composite is up only 5.8%, and the Russell 2000 is actually down 2.4%. So that led to the question of why is the S&P up, and yet every other broad index is really nowhere near as up. It's up very slightly. So we started doing some digging. So let's start by looking at what the index is and compare it to other indexes. So the S&P 500 index is a weighted market index that's supposed to give a broad view on how the U.S. economy is doing. So it looks at 500 securities and it market weights them. Now, market weight means you take the shares outstanding for that stock, multiply times the price of the shares currently, and that gives you your market cap. And the larger the market cap, the larger the weighting that the S&P 500 puts on it. And this makes logical sense over time because large companies with more employees and more revenues are going to contribute more to the overall U.S. economy than a smaller company will. So the logic of the index made sense. When we go back and look at the equal weighted index, which takes the same stocks but says you're all equally weighted, we're finding massive underperformance right now. But really what was interesting was when we took it back to 2000 and looked forward, actually every year the equal weighted index outperformed and during bear markets about the same or slightly underperformed the S&P 500, the market weighted. And again, there's a logic to this because if you've got a broadly expanding economy, then it makes sense that if you have 500 companies, but some are bigger than others, the bigger ones probably don't grow as fast as the smaller ones. But if they're all equally weighted, the overall index is going to perform better than the weighted index. And on the way down, you can see the same thing because smaller companies get sold off a little bit more, bigger companies may be more defensive. You find that it tends to underperform on the way down. This all was fine until we get to 2017. And that's this chart that we're putting up right now. The yellow is the S&P 500 market weighted index, and the blue is the equal weighted index. And you can see that starting in 2017, the equal weighted index started underperforming in both up and down markets. And the further along we get, you get into 21, it's expanded even more. By 2023, the S&P 500 had outperformed even more, and in 2024 had even outperformed more. And so again, this brought us to the question of why? What's going on? So we started doing some digging to see what would have an impact to make the indexes start to skew. And we found some interesting things. The first thing is the Pension Protection Act, which came about, Congress passed it in 2006. And this was an update to the 401ks laws that were developed back in the late 1970s. Now, originally, and for a long time, 401ks required active participation. In other words, when you joined a company and you became eligible to join the 401k plan, you had to actively enroll. You filled out paperwork, you told them how much you wanted to put away and how to invest it. Congress found that not enough people were participating, which many people in the industry had recognized as well. So they said, well, let's reverse it. Let's make it so that it's an automatic enrollment, and they actually have to opt out if they don't want to invest. And they found that was very successful. Far more people started putting away savings. But the problem was the companies said, wait a minute, if they aren't actively participating, they aren't making the investment decisions, we're taking on an investment liability that we don't want to have, because 401ks remove that liability and put it on the individual investors. So Congress said, well, look, if you provide an option that is broad, so it can go from conservative to aggressive, that's both stocks and bonds, that's both foreign and domestic, then we'll remove you of all that liability. So these were passive investments, passive indexes. And in fact, what we now talk about as target maturity indexes or funds were developed specifically to take care of this 401k issue. So that was the start. Then we started noticing around 2017, fewer and fewer stocks in the S&P 500 actually started having an outsized impact on the results of returns. So in 2016, the top 5 components of the S&P 500 contributed about 17% of the return of the S&P 500 that year. By 2021, the top 5 positions contributed about 31% of the returns of the S&P 500. Think about in the last few years how we've talked about in videos that 10, 12, 15 stocks were having an enormous impact on the total returns of the S&P 500. And by 2023, everybody was talking about the Magnificent Seven, 7 stocks that accounted for the vast majority of the returns of the S&P 500. And this year, it's even fewer. It's down to 3 or 4 or 5 stocks are making most of the returns of the S&P 500. So now it becomes apparent as to why the equal weighted index is not even keeping up, let alone underperforming in an upward market versus the S&P 500 index. So the real question is, why do we care? Well, again, remember what the point of the index is. It's supposed to give you a broad indication of what the economy is doing. Well, unless 5 stocks or 3 stocks or 10 stocks are the entire economy, and we know that isn't true, then the S&P 500 index with its returns are not giving us accurate information about how strong the economy is. And that matters as a portfolio manager and as an investor. It's also dangerous. Think about how a passive index works. Passive index, the manager simply buys or sells in the exact weightings of the S&P 500. They don't look at fundamentals. They don't look at whether earnings are going up or down, whether revenues are getting better or worse, whether laws have changed that are going to impact earnings, whether there are problems with their margins because of changes in pay or anything that might be going on that an individual investor would want to know before investing in a company. The passive indexes are not looking at any of that. They're just looking at the money coming in. And so if money comes in every month from a 401k and it's invested in a passive index, it's blindly being invested because nobody is raising a hand saying, wait a minute, but their earnings are slowing down. And that's where you get the kind of volatility that we're now seeing in the past 2 weeks and in the last few days, where all of a sudden you get these violent moves up and violent moves down because of somebody adjusting a position that has an outsized weighting. So, bottom line, we're starting to follow the equal weighted S&P index more than the S&P 500 index. It gives us the same stocks, but it gives us a much clearer picture of really what's going on in the economy. And so we can look and find where things are underperforming and may be attractive versus things that may be overpriced and we think have higher risks. I hope this has been helpful. It's just one piece of the pies that go into what we're doing with portfolios. And like I said, as we produce the next couple of videos in the next few weeks, we'll start to add this all together. It'll make better sense. But on a very big picture, it should give you a good understanding of the risk that you're taking if you're out there just investing in passive indexes. And it also helps explain why, if you're involved in individual securities or in funds that are not indexed, just closet indexes, why for the last couple of years maybe it's been underperforming, just because the overall economy hasn't been as strong as what the S&P 500 index has suggested. I hope you found this helpful. Thank you for listening. As always, if you have questions, feel free to reach out.